Thanks for tuning into Talking Point. I'm your host, Nilesh Shah. The Talking Point this week article last week spoke about how the indications that emanated from all central banks seem to suggest that inflation is the primary worry. It's a cycle that a lot of people might not have seen before. But today, our guest has probably seen many such cycles, is equally adept at trying and figuring out what the cycle and what every individual cycle could mean for both equities or the debt side. And therefore, it's a pleasure to have him today on the show to try and get his perspective of what the near term could hold in store. Mr. Nilesh Shah of Kotak AMC needs no introduction, really, joins us on the show. Nilesh Bhai, as he very popularly is called. Nilesh Bhai, great having you. Thanks for joining in. Hope all is well.
Thank you, Nilesh Bhai.
Okay, so what's your sense about how do you see the current landscape? Because every central bank is sounding hawkish, and coincidentally, starting next month, we'll also have the two large banks turning back or dialing back the taps of liquidity as well. What does this mean for both the asset class, both the predominant asset classes, which is equity and debt?
So, in some sense, Neeraj Bhai, we were betting on subcontinental pitch. Betting was very easy. Now we have suddenly moved into a Australian pitch, which is fast-paced, and you are probably betting on the fifth day of the pitch, fifth day of the match. This is the time to save wicket rather than take risk to score run. If you are there standing on the wicket, someday you will get loose delivery to score run.
Okay, so you're suggesting that people currently should be in the capital preservation mode, so to say, not try and be aggressive in trying to make money.
Absolutely. Avoid leverage. That will be disaster in today's volatile market. Avoid overweight in equity considering all the uncertainties. Avoid high valuation, price to vision stocks. Avoid stocks where floating stock is limited and concentration among certain sets of investors is high. Essentially, go back to quality businesses at reasonable valuations to protect your capital and withstand the current uncertain environment.
Price to vision. I have my headline for the day. Okay, let me try and okay. Before I try and peel open that answer, just a couple of other questions on what the global macro could do as well. So there, as is usual, there are a bunch of events that are moving around, right? In the Russia-Ukraine conflict, or the supply chain snarls caused in part by Chinese lockdown and otherwise, and the central banking action. To your mind, Nilesh, right? What is it that what is that one key trigger, or what are those one or two key things that you would closely monitor in order to try and decipher if there could be a change of trend, whether it happens 3 months, 6 months, 9 months, whatever the case may be?
So, in my view, Neeraj Bhai, this movie will be played in two parts. In the first part, central banks will tighten liquidity and raise rates, as is being conveyed as well as priced by the market. This is to control inflation menace. And as demand destruction sets in around intermission time, we will see second half of movie where central bankers will try to support growth. They may not raise interest rate as much as priced by the market. They may not tighten liquidity as much as feared by the market. This will be essentially driven by some amount of luck and some amount of need. We need to be lucky to get resolution in Russia-Ukraine situation, which in turn can lower energy prices, and also the secondary effect of higher energy prices, especially in Europe. We also need a little bit of need, because as central bankers push towards demand destruction, there is always fear of overshooting into the land of recession. So my guess is that we are likely to see movies in two parts. First part where central bankers are controlling inflation. Second half where, if they are a little bit lucky, they'll start supporting growth.
Hmm. Markets typically tend to discount events well before they happen. How long do you think the first half of the movie could be? Is it even possible to hypothesize?
Unfortunately, no, Neeraj bhai, because this is dependent upon events. If there is regime change in Russia tomorrow, the first half of movie could be much shorter. If there is huge escalation in Ukraine situation, the first half will take a longer period of time. If we look at oil prices, if US takes away sanction on Iran and Venezuela and their oil supply hits market, first half will be much shorter. In case Russia-Ukraine situation escalates further, the first half could be longer. This whole events shaping outcomes will mean that we won't be able to predict how long will be the first half and how long will be the second half.
Got it. What does this mean for a debt investor, Nilesh? I mean, because this is turning out to be quite tricky, and now more so, we have a large bunch of investors who never before seen something like this.
So one, the debt investors will have to figure out what is priced by the market versus what is going to be delivered by the central bank. For example, in India, central bank has raised repo rate by 90 basis point. We are at 490 from 4. However, the market is pricing in a rate hike of another probably 100 basis point. Now, as long as you feel that the actual rate hike by RBI is likely to be more than 100 basis point, you can stay short duration. The day you get conviction that actual rate hike by RBI is likely to be lesser than what is priced by the market, you can be long duration.
Mm-hmm.
It's a technical answer. If you don't understand, then please put money into dynamic bond fund where fund managers will manage duration. They could go right, they could go wrong, but that's the risk you will have to take. Essentially, while your one eye is on central bank action, the second eye will be to reconcile how much of those actions are already reflected into the prices. As you mentioned, Neeraj bhai, market tries to discount things in advance, and a lot of the uncertainties are priced into the market.
Okay. There are always these arguments about whether in India, in ratcheting up interest rates does really serve the purpose of killing inflation or not, because it's supply side and not as much demand led. To your mind, are we on the right track, or would you hope for one or two other things to happen along with, if you will?
So in the current scenario, not only RBI requires on the skill to navigate this uncertain challenge, they also need little bit of luck. Clearly, if I have to lower inflation, I need lower oil prices.
Yeah.
Now, the way to get lower oil prices is either by way of luck that global oil prices come down, or the harder way, the tougher way is to destroy oil demand in India so that my overall oil import bill remains under check, remains under control. I prefer if we are lucky rather than adopting the hard route. But RBI doesn't have a choice. They need to be seen as taking some action in case luck doesn't turn.
Sure. A couple of other questions. I'm tilting the conversation back towards equity. In the last 24 months or 36 months that we've had conversations, there have been a number of promising developments that have happened, which are ushered in new industries, either due to government actions or just the way business is evolving as well. To your mind, are there pockets which may have been, are there pockets which have a long runway of growth, may have run ahead of themselves, or maybe the valuations had gone very high and therefore were prohibitively expensive, but now could be coming or becoming reasonable, and therefore those are the pockets that you yourself would watch out for?
So undoubtedly, Neeraj bhai, banks and financial services have by and large underperformed the market. And fundamentally, valuations are reasonable because of last few years underperformance. Rising interest rates will improve their margin. NPA levels are reasonably under control and despite current challenges are not likely to increase. There is potential that NPS provided for may end up resulting into higher recovery. Put all these things together, improving margin, controlled NPA, potential recovery at fair valuation, there is undoubtedly time to be overweight banks and financial services. We also believe a theme like manufacturing in India could take off over a period of time, but they are unlikely to witness a smooth run. Manufacturing in India will always be subject to ups and downs because of the executional challenges. But over a period of time, we believe China plus one will push more orders into India. We have seen our exports crossing $450 billion, partly driven by inflation, but partly driven by actual growth. We will see domestic market also growing as there is shift from unorganized sector to organized sector. Put together these two things, listed manufacturing sector will benefit from domestic market share gain and also China plus one in exports. Put together, they'll be able to make more money for investors. So these are the kind of themes where you can take a longer term view, but you will have to bear occasional downturn.
Okay. My final question, Nilesh Bhai, would be around exporting themes. I know you mentioned that some of the manufacturing itself will lead to exports as well. What about services? I mean, IT services is split right down the middle when it comes to people having a view on whether they'll withstand the dreaded R word in the US, or will they succumb to pricing pressures and margin issues? You have seen this industry go through various cycles. What's your sense about this one?
So right now, there are two pressures on IT. One is business side from a growth point of view and margin point of view. And second, from valuation point of view. Valuation-wise, Facebook today is a value stock, now called Meta. They are trading in half of, let's say, large Indian IT companies. Even the more profitable giants like Amazon, Microsoft, Apple, Google, they are trading around or marginally below large Indian IT companies' valuation. Now, unless until those companies get re-rated, it is unlikely that Indian IT companies will be able to sustain above their valuation for a long period of time. We can do it for a week or month, but we can't do it for a year. So we'll have to look at global valuation of IT companies to compare with Indian IT companies. The second thing is more fundamental, business and margin. Our feeling is that even in the unlikely scenario of a US recession, we are not disputing that US growth will slow down. All we are stating is that there is a reasonably good chance that US may not dip into recession. The slowing growth scenario will push companies to incur productive expenditure, improve efficiency. And today, digital spending, technology spending will be one way to improve your efficiency and competitiveness. So from a business point of view, I don't really foresee too much challenges. And even if challenges come, it will be temporary, as second half of the movie will soon start with central banks trying to support growth. The real challenge for Indian companies will be on margin. For almost 10 years, we were able to keep entry-level salary at the same level. Now, engineers are in demand. You need to pay them well. Will you be able to pass cost push to the customers, especially when they themselves could be under slowing growth? My feeling is that barring few companies, most IT companies will probably take a hit on the margin in order to maintain growth. And hence, you'll have to really value IT companies from three prism: business, margin, and global valuation. In that overall background, we think mid and small cap IT companies have some more downside. Large cap IT companies, by and large, should become market performer from here onwards.
That's a great explanation, and thanks for giving that whole rounded view, Nilesh bhai. Well, it's a pleasure talking to you as always. Thank you so much for being with us today, and look forward to talk to you more often.
Thank you, Neeraj.
Thank you so much, and viewers, thanks for tuning in to this leg of the Talking Point.